Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is real. Look, if there's one takeaway other than a plus 400 somebody, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
Okay, just so you get a sense of what's causing the agony by this point, I know you've been talking about it. It's financials led by Bear Stearns after what essentially is a bailout from the Fed. Bear Stearns shares are down 90% this morning, and it's not just Bear. Pretty much every single bank is plunging in early trade this morning. Lehman, which is very similar to Bear and its reliance on fixed income, is down nearly 30%. You have big names like Goldman Sachs down 8%, Citigroup down 8%. So it is pain across the board this morning, and as you know, it all emanates from the shock this weekend that J.P. Morgan, along with the Fed, was going to be bailing out Bear Stearns for $2 a share. This is a stock that recently was trading at 80. Last year was trading at 160. It is the fifth biggest bank on Wall Street. It is significant in that it is establishing a price for some of these hard-to-value securities, and as you are well aware, that price is pretty much zero, and that's why you're seeing pain across the street. Now,
this clip shows that as little as 6 days before the Bear Stearns merger with J.P. Morgan, nobody, including Jim Cramer, saw the demise of the company because it was, quote, too big to fail. We will look at one of the root causes of the financial meltdown of 2008, which included too big to fail companies such as Bear Stearns. In addition, we will examine the Dodd-Frank financial reform bill and its implications as to how effective it will be in the future. First and foremost, it is most important to understand that there are several causes that came together to create the financial recession. However, the most important of these causes were companies that were called too big to fail. For example, Bear Stearns, an investment firm, over-leveraged itself and participated in the derivatives market, believing that this strategy would shield them from risk. The scope of its collapse would have been so large, and its systemic risk would have affected so many other institutions that its failure would have caused the collapse of the entire financial market. Because Bear Stearns showed signs of insolvency, the government had to construct a shotgun marriage between them and J.P. Morgan. This proved that the government felt that Bear Stearns was too big to fail. The reason this company caused the recession was that after this merger, the lending practices of other institutions slowed down, which essentially led to Lehman's demise and a global tightening of the credit markets. This example proves that a too-big-to-fail company helped cause the financial recession. A little while after the recession settled down, Senators Barney Frank and Chris Dodd got together to pass a Wall Street financial reform bill. The purpose of this bill was to prevent a future collapse of a similar cause and magnitude. The bill increased oversight of the derivative market by creating an agency under the Federal Reserve. However, the bill does not control the activities of too-big-to-fail institutions. Similarly, it will not prevent these companies from forming in the future. Keep in mind that these institutions were a key factor in creating a recession. Therefore, we feel that the bill does not go far enough, and as a notable Congressman, Alan Grayson.
That's peanuts compared to the trillions in risk that they carry. I don't see it in the legislation.
Well, the answer to your question is there's not enough in the legislation. What the legislation does is simply not enough. What it does is it extends the existing authority to resolve banks, to wind up banks, to other financial type institutions like AIG. And the reason why they claimed there was a need for a bailout in the first place is because they claimed that the Bank Resolution Authority did not extend to insurance companies like AIG. I never really bought that argument, but they're saying that this legislation will permit that. I think the problem goes far deeper than that. I think we have to get away from this idea that we react to crises like this, and we have to try to prevent them. We're facing a crisis in our economy as deep as the crisis existed in the 1890s when the trusts were taking over the economy, and to respond to that, we passed the Sherman Antitrust Act and said there couldn't be a trust. I think we need to do exactly the same thing in this circumstance. Too big to fail means too big to exist. We have to systematically dismantle the institutions that cause a systemic risk to the economy, and that for sure the Senate bill does not do.
Which brings me back, Representative Miller, to my confusion. If 6 banks control 2/3 of the assets, if the White House is against reducing leverage at the giant banks, if there's no reform at Fannie Mae, how is it that taking my bad balance sheet, where I, Dylan Ratigan, owe way more money than I have, and giving it to Congressman Grayson because he's richer than I am, and then ultimately taking
and
more...
better looking, too. Let's
and better
not forget that.
And taller, and from Florida. many differences, definitely taller. If you were to go down a plan of what I call balance sheet contamination, where you go from little guy to the next guy to the next guy and absorb them with your resolution authority, how is infinite balance sheet contamination that ends at the Federal Reserve and with the U.S. dollar the appropriate solution to contaminated balance sheets? When you have a contaminated balance sheet, don't you actually have to decontaminate it by either assigning the forbearance or canceling the debt and restructuring the business, not further contaminating other balance sheets upstream, as this legislation suggests we do, ending with the Federal Reserve and the U.S. currency?
Look, I introduced the House version of the Kaufman-Brown bill that would have limited the size of the banks and required that the big 6 banks be broken up. Alan Grayson is one of the co-sponsors. I wish the Senate had passed that. I wish that was in the final bill. The bill does include, though, I'm still trying to figure out what's in the Senate bill. I know what was in the House bill. And I've been very critical of the House treatment of derivatives. I've been critical on your show and said it was the weakest part of the bill. But at the very least, it does require margin. You can't do what AIG did and just treat the income they got from derivatives contracts, from credit default swap contracts as free money and not set aside, not hedge their risk or set aside reserves or anything and have nothing to pay claims with.
And I don't ask these questions of a referendum on you two as politicians. Quite honestly, it is clear that the two of you understand the issue and are making efforts to address it. But I do ask you, as observers of the political process and participants who are not getting what you want, why it is you're not getting it. And Congressman Grayson, my last question to you, why is it that a bill that clearly does not address too big to fail, that clearly does not address derivatives, that clearly does not address leverage, that clearly does not address Fannie and Freddie, that clearly does not address anything like the balance sheet contamination, is being so wholeheartedly endorsed by the Democratic President of the United States?
Well, the simple answer as to why you end up with a bill like this is that the banks are very strong. A leading senator said a few months ago the banks run the place. That may be a slight exaggeration, but he's the one who said it. And I think what you need to understand is that we have a basic choice we have to make. Do we want government of the people, by the people, and for the people, or of Wall Street, by Wall Street, and for Wall Street? It's disturbing to see how much of this government is actually by Wall Street, and therefore you end up with bills that are for Wall Street.
And that goes all the way to the presidency. And would you not say that this bill here is for Wall Street?
I'm disappointed by the fact that the administration did not push harder for progressive measures that would rescue the economy and prevent the need to rescue the economy.
But let's forget the semantics. Too big to fail lives, and our government on both the Republican, Democratic, executive, legislative, or judicial branch, local, federal, state, I'll go to the dog catcher at this point. Too big to fail still exists, and it's not being addressed, Representative Miller. I got to wrap this up, but do you think it will be?
What infuriated American people and infuriated me is that the too big to fail banks got to play by their own rules.
They still do.
If there is another crisis like what we had, the banks will be wound down. The shareholders will get nothing.
But
management will lose their jobs.
You still have a beast. It's true. When you have a bank that controls a quarter of our assets, if it turns out they have no money, it is impossible not to resolve that without contaminating the balance sheet of our currency and our Federal Reserve.
I could point out a lot of other provisions in there, like the living will provision, but at the bottom, you are not going to have the banks playing by different rules and getting bailed out and having their jobs and their investment protected when every other business in America, the management would lose their jobs and the shareholders would lose everything. Yeah. The same thing is going to happen to them that happens to mid-sized businesses. Yeah.
That's not what's implied in the credit markets. The credit markets price lending to the big banks at a lower price than any other business in America because they have the implicit guarantee of the government.
You know,